So how are all of you doing due diligence now, right? Obviously, in many cases, you can't meet with the founding team. And talk about if you've had a pre-existing relationship. So let's say you met the CEO, how are you doing due diligence? And how are you treating the cases where most of your conversations were video or phone call and you haven't had a chance to meet? How are you approaching due diligence now? And what does the timeline on that look like now compared to before? So who wants to go first? Matthew, it looks like you're...
Sure, I'll jump in. So it's, I mean, we're a pretty remote team overall. We have folks on our investment team, right, from California through to Germany. So we work very well remotely all together on deals. So we're kind of pre-built to kind of be work from home, which is positive. I think we've been pretty productive. We've actually found it easier to schedule some of our KOL calls or engagements with consultants, given that at least for a period, and we'll see going forward, a lot more people just have had more time at home to work and not to travel or not to be in the clinic, things like that. So in a way, that's been a positive. I think in terms of meeting teams, we haven't invested in or produced a term sheet out to teams that we didn't meet before kind of the slowdown. So that's going to be new ground when we get there. Because given that this is such a relationship-based business, we really do value that and find it to be really important to meet in person. On that front, for those that we have been working with on diligence, the frequent check-ins, maybe more so than we would otherwise, to make sure we're all on the same page and talking together has been very helpful, kind of across the board. But as we go, we've been able to build strong initial relationships over Zoom or over Teams, wherever. To start to get to know people. But I think it is an open question, probably one that's maybe case by case for groups who either do more deals or take longer in their process in terms of kind of how we approach that. So on our view, it's a bit of an evolving thing, but on the whole, we're being very productive in the period.
I'm going to ask my fellow panelists. I've been conducting an informal poll of my venture colleagues around a very simple question. I'm curious to hear my panelists, and then I'll share the feedback I've gotten. Would you invest in a management team that you have never met in person?
Well, that's kind of tough. I mean, you could do a lot up to that. I mean, a lot of the paper due diligence, and you can do tons of Zoom. But I think, traditionally for a long-term relationship, isn't it need to be at some point face-to-face? So even with social distancing, that's better than nothing. Maybe you don't have to press the flesh, as we had in the past. Maybe just a elbow bump.
So you're a no.
Minimum. It's tough because I'm not the only one on the team. It takes a team to make the decision, go through due diligence. So it's even if hypothetically I was okay with it, I still got like the whole team to convince, right? And I can tell you that Rich Bendis, he's not comfortable with that. So that's not happening.
So you're a no.
Sorry. Yeah.
Sorry, God, pin you down. Yes or no? You're a no.
All right, a no. Though personally, I think I would be open to at least maybe one.
Okay, Adair?
I'd say no, but there's a caveat because I went against the grain on one deal, but it happened right before COVID hit, and it got into the Column Group deal called Calliope. It's a really fast-growing company in the microbiome with an all-star management team. I never met Nancy Thornberry, the CEO. I talked to her over the phone, and I knew how much of a dogfight it was to get in the deal. So I committed on the spot without meeting the management team, but that was right before COVID. In most cases, no.
Mm-hmm. So if I have to say, I mean, if this, the longer this may take, or in order to be really on the safe side of things, it's going to be hard to not do deals in some way. And I mean, if you're sitting on the, if you're by the sidelines, sure, I guess that could work for a while. But I think fundamentally, I'd probably be on the yes side, as challenging as that might be. But if you have a very lengthy video conversation with somebody versus a lengthy in-person, I don't know, I'd rather not miss a deal because of that. And I think there would be a way to get around it. So I'd say a tentative yes.
So I've asked this question probably of about 15 venture capitalists, and it's actually almost a 50-50 split, which is surprising because you'd think, I would think the answer would be no. for most
Well,
VCs.
I
Because we
don't
always
think,
like we always say, you know, you bet on the jockey, not the horse. It's all about the team, right? That's all cliche stuff. And how do you assess a team that you never met? But I actually think you can.
but
We've
Adam,
actually
yeah,
done
I
it.
mean, it's a co-syndicating, right? If you have a syndicate partner that you feel really strongly you trust and love, and you believe in them. And I mean, I'm sure in Nadir's case, I would gather the people investing, his co-investors, he knew really well. So it's kind of that trust factor. So I kind of waffle. I go back to, you know, Matthew and say, yeah, a yes tentative, because each of us in our portfolio, I know I have, there has been one or two times where I have not met the CEO, but I was co-investing with a really trusted group of folks, and I knew and they pressed the flesh, but for me, right?
Right. So, Andrew, what you're saying, though, it presupposes that someone at some time point has met the people and has had a conversation with them and has felt comfortable with them. So we have all these entrepreneurs on the call saying, I'm just starting. I'm just doing my seed round or my Series A round. I really haven't gotten out to see all these angel groups and all these venture capital groups. Yeah. Is there any hope for me now? Or do I just have to sit on the sidelines and wait?
I think there's hope. I think there's hope in the sense of who do you bring around or bring to bear advisors, KOLs that can give you lift and recognition in a time like this. And so I do think the seed space and the Series A markets have actually been the least affected with valuation drops to a degree, because A, it takes so long, 3 to 6 months to sort of filter through, but B, you haven't seen those growth and scale moments where people have tried to scale as quickly as can and then the market collapses. Like that doesn't affect the seed and Series A side more. So my recommendation is this is a great opportunity for seed entrepreneurs to build their foundation better. And who can you use through your network to strengthen not just your technology applications, but give you recommendation or give you lift with their brand name to help steer your company in the right direction further.
And I think that's a great point. Adair, you mentioned LinkedIn earlier. There's a lot of people that are at home right now and willing to take calls if you reach out to them and ask for advice, whether it's a key opinion leader, another person that you're doing customer discovery, et cetera. They're a lot more open to it than they would be if, say, they were working in an office 9 to 5. But a question to throw back at those of you that think, yes, it's a possibility. Do you think it would impact your valuation of that company if you haven't met the CEO in person?
So before you answer that question, I'll preface it with a little more data. So in 2019, the larger biotechs were up 22%. The smaller biotechs, 400 million or less in capital and valuation, were down 19%. In pre-deal market caps for companies that are less than 300 million, there were significant discounts to follow-on rounds. That's what's happening today. So now think about when you're talking about valuation, and I, as the entrepreneur, come to an angel group or a VC group, how are you going about creating that valuation? Is it on a comp basis? Well, depending on what sector you're looking at, comps could be killer. Is it on a discounted cash flow basis? What are you using, and what can we tell our entrepreneurs how to maximize the valuation that they're going to bring to you without seeming to be too self-serving?
The reality is, look, valuation is determined by one simple factor, and that's competition. Look, I'm on the venture guy, side now, but I'm very empathetic because I was an operator most of my career. And the reality is, investors are going to be opportunistic if they can, but the reality is, they're going to take advantage of market conditions, which is fair. They're going to get the lowest valuation they can get. The only way that you keep investors honest is by creating competition. That's really the only way that you can get what you might consider a fair valuation, because by definition, if you only get one offer and you're willing to accept it, that's a fair valuation. So I wouldn't say that we conscientiously say, well, if we can't meet them in person, that's a 20% discount of what we thought the fair market valuation was. we're going to value the company based on what we think the ultimate exit is. Do we believe we can make 10 times our money at the end of the day? Because we're a seed and Series A investor, so that's the return we're looking at. And that's going to inform whether ultimately we make the investment, right? So it's really belief in the exit valuation that drives it. And then if it becomes competitive, then yeah, valuations get naturally driven up.
Mhm.
Yeah, I'd agree with that kind of from our view. Absolutely. And I think especially now, valuation is not the be all end all of what makes up a deal. If an entrepreneur is really heavy on negotiating, or that's really the sticking point, it could drag out the time to get a deal done. And currently, I mean, there's always the fear that either conditions could change, and there is value in getting a deal done and having money in the bank and getting to actually do the work, assuming, of course, you can actually do the work and the facilities are open. But the lack of risk there is valuable. So, we always talk to companies or who ask about kind of valuations, and it's obviously a component. And for us, we have a process, though, at the very early stages. It's a bit of magic. It's kind of hard to pin down, but I'd see value in getting a deal done in the period rather than dragging it out too long.
I would agree with our colleagues, but I wanted to add some more data because I love data just like Dr. Jeffrey. So Wilson Sonsini sent out their entrepreneurs report on private company financing trends. And it said that for Series A, the pre-money valuation Q1, right, 2020, 9 million. And it was the same as Q4 last year, right? And Series A, the pre-money valuation, these are averages, right, 30 million. And actually went up from Q4 2019. Series B went down significantly, and then Series C shot through the rocket. I mean, it was amazing. It was like Series C was 213 million last quarter, 2019, and this last quarter, 225 million. So I think in addition to what Adam and Matthew had to say, we're also going to be looking at some of these reports. So that will affect some of our thinking on terms and deals.
Mm-hmm.
I think the old axiom applies, right? I mean, take money when it's offered to you, right? If in this environment, it's tough to raise. If you have an investor who can add value, and here's what I think a lot of entrepreneurs miss. At the seed and Series A stage, the dilution when you roll out your cap table is generally not significant. Whether you're raising $2 million at a $6 million pre or an $8 million pre, it's inconsequential when you roll out the cap table to a successful exit, right? So you want investors who can truly add value. And on my companies, I've taken a haircut on valuation because I wanted top tier venture funds in my deal who I knew could add value from an operating standpoint, from a network perspective, could continue to fund the company if we needed them, right? So that should sort of drive your decision on who you want to invest in your company. And I think most entrepreneurs should be a lot less valuation sensitive than they are. Easy for me to say because I'm on the investor side now.